In this lesson, we're going to look at assets, specifically fixed assets. What are fixed assets? Well, fixed assets are usually longer term or relatively permanent assets, such as our equipment, machinery, buildings, and land. Other titles for fixed assets that you will see are plant assets or property, plant, and equipment. Some designation to let you know that these are long-term, non-current fixed assets. What are the characteristics of fixed assets? Well, they are tangible. That means that they physically exist. You can touch them. They are owned by the business and used by the business in its normal operations. This means the asset is producing revenue for the company. They are not offered for sale as part of a normal operating activity. It means it's not their inventory. Identifying the asset cost. As we know, assets are listed on the books at historical cost. What items go into that price, that money, cost? How do we get that dollar figure to put on our asset ledger? Well, it's all necessary costs to purchase the asset and get it ready for its intended use. There are some costs that are not included in the asset. These are unnecessary costs and they do not increase the asset's usefulness, and so they are recorded as an expense. Some examples of things that may be incurred while purchasing an asset could be vandalism, mistakes in installation, uninsured theft, damage during unpacking and installing, and fines for not obtaining proper permits from government agencies. We have some vocabulary words we need to look at, and they are capital expenditures and revenue expenditures. Capital expenditures are expenditures that benefit future periods. These would be included in the asset account. We would debit a fixed asset account. Expenditures that benefit only the current period are called revenue expenditures. These expenditures would be expense items and be recorded as a debit to an expense account. Capital expenditures include things like asset improvement. Asset improvement could be additions, such as enlarging an asset or adding a new feature, betterment, increasing operating efficiency or capacity, and extraordinary repairs. Extraordinary repairs extend the service life of an asset, and that goes back to our definition of providing a future benefit past the current period. It must provide a future benefit. Revenue expenditures are the items that we're going to list as an expense, and these include ordinary maintenance and repair items to keep and maintain the asset in current working condition. There is a worksheet in the File section, and it is entitled Acquisition Notes and Worksheets with Solutions. We're going to look at an example and walk through. This is the acquisition of a fixed asset for machinery and equipment. Nearby Computer Services, a computer repair company, purchased a machine that will refurbish motherboards. The cost associated with acquiring the machine are listed below. Where should each cost be recorded in the accounting records? We have the purchase price. Well, that's going to be part of our asset. We can assuredly say that's an asset debit, probably to a machine. Transportation. That is on the list provided in the worksheet. Transportation to the location to be used, that becomes part of the asset. Installation, that becomes part of the asset. So those would all be debits to machine. Cost of testing prior to service. Yes, this is getting our asset ready for use. So that's going to go to the asset machine, debit. Cost of a 5-year contract. This is tricky. This is a prepaid expense. Prepaid expense. Fee for new power outlet. This power outlet was used to hook the machine up. We needed it to make the machine useful. That is an asset. It's going to be asset debit machine. Repair to the building for damages during installation. This one is going to be a repairs expense. If you continue looking at your worksheet, you will see that there are some notes regarding cost included in acquiring a building and cost included in acquiring land, and cost specific to land improvements. Then there is a sample item to work. That is this one. XYZ Corporation purchased land as a building site. The following costs were incurred. Identify which costs are building, land improvements, or expense. Well, we have the land included an old storage unit facility. The land is appraised at $95,000. The old storage unit facility is appraised at $150,000. Total cost $245,000. What would we do with those numbers? Where would they go? Well, they're all going in land. We have a land account for $245,000. Closing cost. Those also go to land. Cost to tear down an existing structure. Land. If we go back to our definition says all cost incurred to bring the asset ready to use. Closing cost. Cost to tear down the structure. Salvage items. This one is a credit to land. It offsets the tear down. Cost to prepare the land for construction. Well, that's going to go also to land. Cost for the architect and construction engineer. Well, what are they in charge of? They're not in charge of the land. They're in charge of the new building. So this is going to be a debit to building. Interest paid on construction loan while in construction. Well, in construction, loan interest is going to be part of the building. Further down on our worksheet, we have the cost of a parking lot for a new building. Well, parking lots are part of land improvements. Cost of landscaping, that's also land improvements. Repairs from a snowstorm. So a snowstorm damaged your construction site. That's an expensed item. This concludes part 1.